Hello and welcome to the Wealth Advice Market Update for Friday the 12th of November. I'm Matthew, one of the advisors at Wealth Advice. As many of you will know, America has reopened its borders to Europeans this week, and Chris has taken this opportunity to have a well-deserved break. The reopening of international borders and the surge in tourism is a good sign for the global economy. In our last update, we discussed how September was the worst month for stock market returns since March 2020, with volatility returning. Today, I will talk about the key points from the autumn budget, stock markets bouncing back strongly, and comment on UK interest rates. Since the last update, Rishi Sunak held the autumn budget to present the government's plans for spending. There were no huge shocks in the budget, and we'll go over some of the key points now. Looking at pensions, there were no significant changes announced. There was no changes to tax relief on contributions, no changes to tax-free cash, and no changes to the annual allowance or the lifetime allowance. When we look at the state pension, the government has temporarily suspended the earnings element of the triple lock. The triple lock is used to revaluate pensions each year. For the 2022-23 tax year, the state pension will increase by the higher of CPI inflation or 2.5%. The reason behind the suspension is that the average earnings index, which measures the growth of earnings, that jumped by 8.3% this year. And when we look back where we were a year ago, that makes sense with things like furlough being introduced and the impact of COVID. The Treasury and the Bank of England both believe this is to be a one-off event caused by workers returning from furlough, artificially inflating wages compared to this time last year. When we move on to think about the national insurance contributions, they've increased to help fund social care. From April 22, an extra 1.25% will be added to each national insurance band for employees and employers and those who are self-employed to help pay for social care reforms. Each dividend tax band will also increase by 1.25%. Corporation tax is also set to rise to 25% from April 2023. However, companies with profits below 50,000 will continue to pay at the current rate of 19%. There will also be a reintroduction of tapering relief for businesses with profits under 250,000, so they pay less than the main rate. It was also announced that the national living wage, which is currently £8.91 per hour, would increase by 6.6% to £9.50 per hour, taking effect from April 2022. When we move on to think about interest rates, last week the Bank of England maintained interest rates at 0.1%. The Monetary Policy Committee said that there is value in waiting to see how the jobs markets coped with the end of furlough. They have not ruled out a future interest rate rise in the near future. However, interest rates won't return to levels seen before the 2008 financial crisis. When we talk to fund managers and other industry professionals, we always hear the phrase that we're in a world of low interest rates for the foreseeable future. In relation to the housing market, despite the Bank of England holding interest rates at 0.1%, there's been recent stories that lenders are expecting to increase mortgage rates. Lenders are beginning to price in the future rises to interest rates in the next couple of years. Official forecasters expect the largest rate increases to happen in 2023. If mortgage rates were to increase by 0.25% on average, those homeowners with a tracker mortgage could expect to see an increase of around £26 per month. UK house prices have risen between 8 to 10% over the past year. The Office for Budget Responsibility expects the housing boom to slow in the coming years. House prices are forecast to rise by around 3.2% in 2022, slowing into 2023 before steadily rising again when growth normalises. In keeping with our regular updates, we'll now move on to look at US market news. In the US, the Federal Reserve have announced that they will start to slow bond purchases in November. The Federal Reserve and the other central banks around the world have bought government and corporate bonds at large scale since March 2020. This quantitative easing helps to stimulate economic activity. The Fed currently buys $120 billion worth of assets every month, and they will scale back to $15 billion each month going forward. This is the first sign that the Federal Reserve feel the economy have stabilised and have recovered well post-COVID. US Fed officials have said that they do not intend to raise interest rates until into 2022 once bond tapering has completed. markets have expected bond purchases to slow and the initial reaction was positive. The S&P 500 and the Dow Jones Industrial Average indices in the US have both reached new all-time highs. This week we've heard from a number of fund managers for updates on their various funds and sectors. This asset allocation quilt from Royal London helpfully demonstrates how various asset classes have performed over the past decade. It's interesting to see that the top performing asset in one year might have been one of the lowest in previous years. This helps to demonstrate the importance of investing in a diversified portfolio and how both performance and volatility can be managed. UK stocks have underperformed last year as the UK service-led economy was affected particularly badly by COVID lockdowns. It's encouraging to see UK stocks have recovered well in 2021. Looking at past news headlines, it's 1 year since the 9th of November 2020 when Pfizer was the first company to announce a successful COVID-19 vaccine. As you'll see from the next graph, the UK FTSE 100 bounced 8% on the news, whereas the US S&P 500 only grew by 1.4%. The graph shows how markets have performed over the past year. At the time of our last update in mid-October, markets had come off the back of a poor month in September. While we do expect market growth to begin to slow slightly as economies have largely recovered, it's encouraging to see October was a positive month for stock markets. This graph shows how markets have performed over the past 3 years. While UK markets have had a strong 12-month, over the longer term, the UK continues to lag global stocks. This goes to show diversification across various geographies is as important as ever and why it's important not to have a bias to a certain market. Finally, I know this is a popular bit of the market update. How have our portfolios performed since the last video? In the last update, Chris highlighted that over the previous 4 or 5 weeks, any new clients that had invested funds could have seen a slight loss. As you can see from the chart, both our Risk Score 2 and Risk Score 3 portfolios have had strong performance over the last few weeks, and the notional £100,000 invested in February last year is now up to around £116,360 for Risk Score 3 and £112,580 for Risk Score 2. It's a well-used phrase, but our consistent message is the importance of timing the market rather than timing the market. To wrap up this video, we've looked at how the markets have performed well over recent weeks. We've looked at the key points for the autumn budget, and then we've looked at how UK interest rates haven't been increased from the Bank of England, but that they're likely to in the future. As always, we hope you found this interesting and informative, and if you've got any questions that could feed into future updates, please send them through. Thank you very much.